Hi, welcome back. To the session to accompany Chapter 2 of my Little Book of Valuation. In this session, I'd like to focus on what I call the tools of the trade. What does that mean? Before you start in any finance class, there are certain tools that you need to draw on because these are the tools you come back to repeatedly. In this session, I'd like to cover three basic tools. The first relates to how we think about and measure risk in finance. The second to the present value, the time value of money. And the third to how we think about data, statistics. So let's start with the time value of money. I know in every finance class, you're given the saying, time is money. There is a time value to money, but where does that come from? Fundamentally, there are three forces that lead you to value a dollar today more than a dollar a year from now or 10 years from now. The first is, as human beings, we're impatient. Some of us are less impatient than others, but we all prefer to consume today as opposed to consuming in the future. Second, inflation eats away, especially if you're talking in terms of currency. If you have a high inflation currency and I offer you a unit of that currency today, as opposed to a unit of the currency 10 years from now, you're going to take it today because you can buy more stuff with it. And third, I could promise you a cash flow 10 years from now, but I've got to be around to deliver it. There's uncertainty, there's risk. So there's time preference for consumption. The second is inflation. The third is risk. The process by which we bring these into the cash flows, we adjust the cash flows for timing, is called discounting. And the rate that reflects all of the things we've talked about, inflation, our preference for current consumption and risk, is called the discount rate. I know that we now have calculators and spreadsheets that have present value buttons built on them, but all of those present value equations draw on some very simple equations that are built in behind the present value button. So the risk of being old-fashioned, I'm going to go behind the curtain and talk about how present values get computed. Fundamentally, there are 5 types of cash flows you will run into in finance. The first is a single cash flow way out in the future. $10 million 10 years from now. If you ask me what the present value of it is, you take that cash flow 10 years from now, you take 1 plus the discount rate. So if your discount rate is 12%, 1.12 raised to the power 10. Bringing it back gives you the present value of a single cash flow. The second type of cash flow is called an annuity. An annuity is a constant cash flow, the same cash flow at regular time periods for a certain period of time. So if I promise you $1 million every year for the next 10 years, you have an annuity. Now note, it doesn't have to be years, it can be months, but let's stay with the 1 year analogy. You get $1 million every year for the next 10 years. There are 2 ways you can compute its present value. One is you can take the present value of each cash flow, year 1, year 2, bring them back to the present, add them all up. That'll always work, but that's a lot of work, right? Especially if you get to 10, 20, 30 year cash flows. So the second approach is to use a present value equation that captures those 10 cash flows. This is called the present value of an annuity. And to get the present value of an annuity, here's what you do. You take the annual cash flow $1 million, and then you multiply by that factor that reflects both the discount rate, 10, 12, 8%, whatever it is, and the number of periods for which you get the cash flow. So it's 10 periods, you put in 10. That's the present value of an annuity. You can also have a growing annuity. A growing annuity is a cash flow growing at a constant rate for a finite period. So let's suppose I told you I'll pay $1 million growing at 3% a year for the next 25 years. Again, you can compute the present value the long way. You can take each cash flow, discount it back to today, add them all up and come up with the present value. But there's a shortcut. In the shortcut, here's what you do. You start with the expected cash flow next year. So the cash flow 1 plus G. So if you have $1 million growing at 3%, you'll have 1.03 million as your starting cash flow. And then in the factor, you bring in both the discount rate, 8, 9, 10%, as well as the growth rate, 3%. And what you get in one step is the present value of a growing annuity. You don't believe me? Try it out. The best way to make sure you're comfortable with present value equations is put them down, work it out both ways. The long way we take each cash flow and the shortcut. And finally, you get 2 cash flows that are mind-boggling to begin with, cash flows that last forever. Now, the first is a cash flow that's constant every year forever. It's called a perpetuity. So as an example, if I offered you $5 a year every year forever, that's a perpetuity. The present value of that perpetuity is the cash flow each period, $5, divided by your discount rate. Let's say it's 10%. 5 divided by 0.1 gives you $50. One way to think about a perpetuity is you take that $50, you put it in the bank. At a 10% rate, you will make $5 every year forever. The last type of cash flow is called a growing perpetuity. In a growing perpetuity, you have a cash flow growing at a constant rate forever. So if I tell you a stock is paying a $2 dividend and that dividend is expected to grow 2% a year forever, the present value of that growing perpetuity is the expected cash flow next year. Notice the pattern here, it's always the cash flow next year, which will be $2 growing at 2%, $2.04, divided by the difference between your discount rate and your growth rate. Now, as you look at the denominator, notice that you have a discount rate and a growth rate. And if you keep increasing your growth rate, you can get into trouble. Trouble in what sense? At some point in time, the denominator can become zero and become negative. But remember, these are cash flows that grow at a constant rate forever. So that growth rate has to be capped at the growth rate of the economy. More on that later when we get to terminal value calculations in discounted cash flow valuation. So it's time value of money. Learning how to move cash flows across time is critical to finance. Almost everything in finance is a time value problem. Next, let's talk about risk. Until the 1950s, the way investors thought about risk in equity markets was an extension of the way they thought about risk in the bond market. A little bit of history. Bond markets preceded equity markets. So when equity markets first opened up, they tried to look like bonds. In fact, I would argue that the reason you see dividends on stocks, where the dividends are set, they're fixed, is because you wanted stocks to look like bonds. So the dividend became the replacement for the coupon. And the way investors thought about risk in equities was analogous to the way they thought about risk in bonds. They thought about default risk. They thought about the fact that their dividends might not be paid, and they stopped there. But each stock was assessed based on its own risk. In the 1950s, Harry Markowitz revolutionized the way we think about risk by bringing in basic statistics. What he brought in was the law of large numbers. He said, look, if I have 30 or 40 stocks in a portfolio, the risk of a stock is not just how much it moves, but how much it co-moves with the rest of the portfolio. Put simply, the risk of a stock to an investor who already has a portfolio is the risk it adds to the portfolio. It was revolutionary, and here's why. It basically meant that when you thought about risk in a stock, you had to think about risk that it would add to a diversified portfolio rather than risk standing alone. And that is what animates how we think about risk and return in finance. In fact, in finance, the risk we try to measure to bring into our required returns is a risk we cannot diversify away. Because the rest we can effortlessly diversify away by holding not just hundreds of stocks, but maybe 15 or 20 stocks. The most widely used risk and return model in finance, and still the default in many consulting firms and appraisal houses, is the capital asset pricing model, or the CAPM as it's called. It's built on two assumptions, neither of which is realistic, but it gives us a model that's incredibly simple and usable. The first assumption it makes is there are no transactions costs. In other words, you can keep adding stocks to your portfolio with no, not just brokerage costs, but no bid-ask spread and other transactions costs. Second, the CAPM assumes that there is no private information. That's just a euphemism for you don't know which stocks are underpriced and which stocks are overpriced. If there are no transactions costs and you can't pick stocks, you know what you're going to do? You're going to keep diversifying and diversifying until you have every single traded asset in the market in your portfolio. You might say that's absurd, but it is the end game. If you have no transactions costs, why stop when you can get a more diversified portfolio? That portfolio is called the market portfolio, and if you believe in it, then the risk of a stock becomes the risk it adds to the market portfolio. And that risk is captured by how the stock moves with the market portfolio. In statistical terms, that's called the covariance. And the covariance scale to the variance of the market is called the beta, a Greek alphabet, but the beta comes with an advantage. Unlike a covariance, which is a number that's tough to read, betas are scaled around 1. What does that mean? A stock with a beta 1 is about average risk. A stock with a beta above 1 is above average risk, and below 1 is below average risk. But remember again, beta doesn't measure overall risk. It measures the risk added to a diversified portfolio. The advantage of having a beta is you can convert into an expected return with a very simple equation. You start with the risk-free rate, the base that you're going to demand no matter what investment you look at. And then you add a premium. That's a function of two things. One is the beta of your stock. Is it above average, below average, about average? Multiplied by the price of risk in the equity market or an equity risk premium. We'll come back and talk about measuring risk-free rates, betas, and equity risk premiums, but they reflect the origins of finance in the capital asset pricing model. Now, it is true, the capital asset pricing model in the decade since it came out in 1964 has been found to be flawed. Flawed in what sense? It seems to underestimate the expected returns on small cap stocks with small companies in terms of market capitalization. And it does make unrealistic assumptions. But it stays in there. I mean, in the last 60 years, there have probably been 5 or 6 competitors that have emerged to the CAPM. One is called the arbitrage pricing model, which allows for multiple factors, mostly statistical, that try to capture market risk. Then there are multi-factor models where you try to break down market risk into individual components, interest rate risk, term structure risk. And then you had proxy models. You ran regressions trying to measure what the returns were for stocks and why some stocks earn higher returns than others. Each of these models has challenged the CAPM, but the CAPM has survived for 2 reasons. One is none of these alternative models deliver better results when it comes to expected returns. They may explain the past better, but in investing, where it's all about the future, none of them deliver results that are significantly better than the CAPM, and they all take a lot more work. Now, I know you might not agree with the CAPM. You might think betas are flawed. After all, Warren Buffett has said how little he thinks about betas. Okay, that's fine. But there is no disputing the following. First is risk matters. You might not agree with the CAPM. You might not like any of the risk and return models in finance, but risk matters in investing. Second, not all investments are equally risky. When I hear people tell me that they use a hurdle rate of 10% for every company, that doesn't make any sense to me. Some companies are riskier than others. How can you demand the same return in every investment? And finally, let's be real. I mean, if you're talking about value, the price of risk should affect value. The higher the price of risk, the lower the value of a business. So even if you don't buy into the CAPM or any of the alternative models, find a way to measure risk and bring it into value. Which brings me to my third piece of this session, which is about accounting. I say some terrible things about accountants, and I would apologize, but I mean every word of it. But let's face it, we have no choice in investing. Our raw data comes from accounting, and you have to understand that raw data to be able to value companies. At the risk of being simplistic, there are 3 basic accounting statements. The first is the balance sheet, which records at least what accountants think about measure as what you own and what you owe, and what they think your equity is worth. Then there's the income statement. That's the accountant's attempt to measure how much you generated as earnings last year. And then there's a statement of cash flows, which from an accounting perspective looks at cash coming in, cash going out, and what the net cash effects are on your company. So let's take each of these statements and at least get an accounting perspective. When you look at an accounting balance sheet, you get a mix of rules based upon what is being measured. So if you're looking at non-cash current assets, land, building, equipment, when we're talking about non-cash current assets, we're talking about inventory, receivables. They're usually recorded at cost, and that cost is pretty close to current market value. Cash and marketable securities, thank God, is usually recorded at current value. But if you have property, plant, equipment, fixed assets, in much of the world, they're still recorded at original cost. I know IFRS is starting to deviate from the script, but at least according to GAAP, those assets have to be recorded original cost, net of whatever the accountant thinks they've lost in value. They call it depreciation. It's an accounting depreciation, so it's original cost net of depreciation. If you have financial investments in other companies, the way they're recorded depends on the motive for the holding. If you're holding an investment for trading, they have to be marked to market. But if you're holding them as strategic, as something you need for your ongoing business, then you record them at original amounts or book value adjusted. And finally, there is this item of intangibles. Accountants like to talk the big game on intangibles. When push comes to shove, though, the most common intangible you will see on a balance sheet is called goodwill. It's the most useless asset known to man because it's really a plug variable. It shows up when you acquire another company, and the plug is the difference between the price you pay for the company and the book value for that company adjusted. Now, on the other side of the balance sheet, you see the same accounting inconsistencies come to play out on the liability side. If you have current liabilities, accounts payable, supplier credit, deferred taxes, deferred other items, you record them at cost. And usually that cost is pretty close to market value. If you have interest-bearing debt, you record the original proceeds. So if you borrowed money in 2019, that debt is stated at the 2019 debt level. So unlike some items that are marked to market, debt usually is not. If you have other accounting liabilities, and increasingly over time as accountants have passed rules, these items have plugged up, they're recorded whatever the accounting rules reflect them to be, which leaves you with shareholders' equity. Now, that might sound like a number that reflects everything in the company, but if you look at how assets and liabilities are recorded, shareholders' equity is the ultimate backward-looking number. It reflects the history of the company. What do I mean by that? When you look at Coca-Cola's balance sheet and you look at the shareholders' equity, it actually includes the money raised by Coca-Cola at its IPO. When was that? I have no idea, a century ago? Plus or minus retained earnings since, plus other adjustments accountants make. It is the ultimate backward-looking number. So let's move on to the income statement. In the income statement, at least for non-financial service companies, you always start with revenues or sales. From that, you subtract out cost of goods sold. Now, if accountants are staying true to first principles, this should reflect the cost of the units that you're showing sold in revenues. So those are the direct costs associated with producing the product or the service. So if you're a manufacturing company, the cost of making the cars or the machines you sell should be in your cost of goods sold. You subtract cost of goods sold from revenues, you get gross profit. From your gross profit, you subtract out other operating expenses. And again, generically, if you stay true to accounting first principles, these operating expenses are expenses again associated with delivering revenues this year, but they're not directly connected to the production and the sales. What would be here? G&A, general and administrative costs, selling expenses, expenses that create your revenues but are not directly connected to the revenues on a unit-to-unit basis. So you subtract out operating expenses, and incidentally, depreciation of past financial assets that you bought in previous years should also show up in your operating expenses. You subtract them out. From gross profit, you arrive at operating profit. Think of operating profit as what your business generates as earnings. As opposed to what? Well, to the extent that you're funding your business with debt and there are interest expenses or interest-like expenses associated with that, you subtract those financial expenses. To the extent that your cash earns income for you, you add that on as financial income. This could also include income from cross-holdings. You get a pre-tax profit, and from that you subtract out the taxes that you would pay. Now, these are what are called accrual taxes. These are not the cash taxes you pay. These are the taxes based on your pre-tax income. In fact, if you divide the taxes by that pre-tax profit, you get what's called an effective tax rate, an average tax rate this company paid across all of its income, which brings you to the bottom line, which is net profit. You divide that by the number of shares, you get earnings per share. Now you can debate what the number of shares should be. Should I count only the shares outstanding? That's called primary earnings per share. Should I count potential shares outstanding, including shares underlying options and restricted stock? That's called diluted earnings per share. The final statement that accountants churn out, and this to me is actually one of the more valuable statements because it reflects the truth in a business, is the statement of cash flows. And across the world, for the most part, the statement of cash flows has three parts to it. The first are what are called operating cash flows. But remember earlier I talked about operating income. The accountant's measure of operating cash flow is really operating cash flow to equity investors. It starts with net income, which is after interest expenses. It adds back those non-cash charges we talked about, depreciation, amortization. And then it subtracts out the change in working capital broken down into individual items. You're saying, why would I want to do that? Remember, income statements are based on accrual accounting. What does that mean? When you sell something on December 30th, you have to show it as revenues this year, even though you haven't been paid for it yet. You're saying, so what? That's what shows up as accounts receivable. If you've used items you haven't paid for yet, it has to show up in your income statement this year, but you should, because you haven't paid for them, you have accounts payable. Think of working capital as a residue of accrual accounting. So when we subtract out the change in working capital, receivables, inventory, other current assets, payables, we're making accrual income into cash income. Net income plus non-cash charges, depreciation, amortization, minus change in working capital gives you cash flow from operations. Now, incidentally, in a statement of cash flows, the signs of the cash flows already tell you whether it's a cash outflow or a cash inflow. So you have the cash from operations. The second section is usually cash flows from investing. So if you're investing in land, building, equipment, factories, this is where it'll show up. But that's not all. If you're doing acquisitions, you're paying for them with cash, it should be in here as well. But the waters are muddied a little bit because you make investments in financial assets or in other companies, it's also shown as other investing activities. Which brings us to the third and final section, which is cash flows from financing. When you borrow money, cash comes into the company. That's a cash inflow. When you repay debt, it's cash outflows. So you have to show cash inflows and outflows from debt. In addition, because we're looking at the entire company, you'll also see dividends, if a company pays dividends, as a cash outflow. Stock buybacks as a cash outflow, and stock issuance as a cash inflow. The statement of cash flows is really not about explaining the cash flows you will use in valuation. It's really about explaining why cash balances at a company change from year to year. So when you get a chance, take a look at a company's financials and go through the balance sheet, the income statement, the statement of cash flows. Incidentally, financial statements are stated in dollar values and absolute values. And if you're comparing companies, you can't compare absolute values. Why not? You compare a big company to a small company, the big company will always look more profitable because it's just bigger. So usually when you look at profitability, you try to scale your profits to something. And there are two generic ways in which profits can be scaled. One is to revenues. When you scale profits to revenues, you get what's called a margin. Here again, depending on what measure of profits used, can be at very different measures of margin. For instance, we talked about gross profit. Gross profit is the profit left over after you've subtracted out just cost of goods sold. Gross profit divided by revenues gives you gross margin. What does that tell you? It tells you something about the unit economics of this business. If a company doesn't spend much on the next unit that it sells, it's got great unit economics, it should have a high gross margin. You can divide the operating income by sales. It's called the operating margin. This reflects things like SG&A, R&D, other expenses that are related to revenues, but they're not directly connected to that next unit sold. It's called operating margin. Or you can divide net income by revenues, in which case you get net margin, what's left over after financial expenses and taxes. Incidentally, there are other versions of margins you might run into. I can take the operating income, add back the depreciation, it's called EBITDA, divided by sales. It's called EBITDA margin, measures in a rough sense the operating cash margin of this company. Or I can take the taxes out of operating income. Remember, with the effective tax rate, act like the entire operating income is taxed and come up with an after-tax operating margin. So that's one way to measure profitability, is relative to sales. The other way to measure profitability is relative to what's invested in the company. Again, keep your accounting hat on, because the way accountants measure what's invested in a company is they look at the book values of the investments. So if I'm looking at net income, I'm going to scale it to what I've invested in equity, which if I trust the accountants, the shareholders' equity or book equity, net income divided by book value of equity is called return on equity. I could also look at after-tax operating income. Remember the operating income net of taxes I talked about on the last slide, and divided by the total amount invested in this company. You're saying, what does that mean? I'm going to take book value of equity, plus I'm going to add book value of debt, because debt is also invested in the company. and I'm going to subtract out cash. Why? Because cash is not invested in the assets that generate the operating income. It's a consistency reason. That gives you what's called return on invested capital or return on capital. So when you think about measuring profitability, you'll run into both those measures. Now, incidentally, one of the things I argue for in every one of my finance classes, especially when people come in from an accounting class, is I tell them of how they need to switch mindsets. Accounting, as you can see it, is backward looking. A balance sheet, no matter how hard accountants try, reflects a company's history. And let's face it, somebody has to record that history. Finance is forward looking, not backward looking. In fact, I have a version of a balance sheet called a financial balance sheet, where rather than look at what a company's done in the past, I look at what it's already done and reflect the value of what it's done in two components. The first is the value of assets in place, investments it's already made, and what I think the value of those assets is. That's straightforward enough. But the second item is called growth assets. You're saying, what is that? That's a value I'm attaching to investments I think you will make in the future. I'm giving you credit for investments you haven't even thought about yet. Finance is forward-looking. It's much simpler. It doesn't draw this distinction between different kinds of assets. And ultimately, there are only two ways you can fund a business, debt and equity. And in finance, those are forward-looking numbers. Put simply, you can have a young company with a book value of equity that's actually negative. It can happen in an accounting balance sheet. The market value of equity in the billions. Finance is forward-looking and principle-driven. Accounting is backward-looking and rule-driven. We need both. I'm glad I'm not an accountant, that somebody does the raw data for me. But without that accounting data, I could not do much of finance. Which brings me to the basics of data. We live in an age where we can't complain that we don't have enough data. We often have too much data. And making sense of data is key to doing valuation, doing corporate financial analysis. There are three ways I can present the data. One is I can give you all of the data. So for instance, if you ask me what the PE ratios are for software companies, I could take the 650 publicly traded software companies and give you 650 companies' PE ratios, each individually. You're going to drown in the data, right? Which is one reason why we present summary statistics. What are summary statistics? I take the 650 companies and their PE ratios and I try to compute the average, the median. Basic statistics. We do it because we want to grapple with the data and make sense of the data. Now, incidentally, in addition to summary statistics, there's a second way I can give you the data to make sense. I can present them as distributions. What does that mean? I take all of the data and rather than just give you a summary statistic, the median is this much, I give you the distribution of PE ratios, maybe as a picture. And the advantage of distributions is I can summarize a data set, 48,000 companies, which is what I use at the start of every year to do my data analysis, in a distribution of PE ratios. That distribution has all of the embedded pieces you can use in analyzing the data. What's high, what's low, what's typical is all in the distribution. Incidentally, when you start presenting data in distributions, you're going to run into types of distributions. I know this seems like a throwback to your statistics class and you're not liking it, but there is an advantage to statistics. First, generically, distributions can either be symmetric or asymmetric. What's a symmetric distribution? Your upside and your downside are pretty even. Asymmetric distributions basically are more likely to get high positive values if you have a positively skewed distribution, or high negative values if you have an asymmetric distribution. For the moment, you might not care, but later when we talk about valuing companies, this is going to come into play into how risk plays out in valuation. And finally, when you have two sets of data, two variables, one of the things naturally to ask is, are they related to each other? Let's take an example. Later in this class, we're going to talk about interest rates and how inflation is a big driver of interest rates. High inflation leads to higher interest rates. I want to test this proposition out. How would I check it? I went back and collected interest rate data for the last 60 years and inflation data for the last 60 years. I plot them. It's called a scatter plot. Basically, I take each year's data and I plot it out. There aren't quite 60 years of data in this particular case, but you plot all of them, you get a scatter plot. And then to find the relationship, you look for a best fit line. You're saying, what does that even mean? Now, statistically, the best fit line is the one that minimizes the square distances from the point. So you're trying to find a line that best fits the data. When you fit that line, you've got a regression line. For instance, in this particular case, let's suppose the regression line tells you the interest rate is equal to 1.5%, that's called the intercept, plus 0.8, that's the slope, times the inflation rate. It says the R squared is 60%. Let's break down that regression very simplistically. Let's start with the R squared. 60% of the variation in interest rates is explained just by changes in inflation. Obviously, if it's 100%, you're explaining all of the relationship. If it's 0%, you're explaining none of it. So that's the range, 0 to 100%. What's the point? What's a 1.5%? It's a starting point. It's your base. So one way to think about it is when my inflation rate is 0%, what will happen to interest rates? And the answer is they'll be about 1.5%. Incidentally, if you've ever heard the term real interest rate, one way to get a real interest rate is to do this regression and use the intercept as your real interest rate. What does the slope of 0.8 tell me? If my inflation rate is 2%, my expected interest rate will be 3.1%. That's 1.5% plus 0.8 times 2%. And incidentally, if you tell me that you're worried about inflation going up, I can quantify that effect on interest rates. So let's summarize. There are three things, three basic tools, and none of them are complicated. They're easy enough to get. The first is understanding time value of money. That goes beyond just hitting the PV button on your calculator or on a spreadsheet. Second, understanding accounting. Less accounting debit credit and more reading financial statements. Income statements, balance sheet statements of cash flows, keeping the door open to how finance thinks differently. And finally, data. How we try to make sense of large amounts of data. It's a problem that increasingly we're facing. I hope you find this chapter useful. I know it's simplistic, it's very basic. And if you're really interested in any one of these things, there's much more you can learn. But for the moment, this is all we need to keep going in this book. Thank you.